Picture this. You discover a loophole in the system, a sequence of actions that, every time you execute them, generates profit with zero risk. You trigger it once, money flows in. You trigger it again, more money appears. There's no gamble involved, no expertise required. Just a structural weakness that permits unlimited extraction of value. Now imagine getting caught. Authorities document everything, the transactions, the methods, the stolen gains. But instead of facing real consequences, they propose a deal. Surrender a tiny fraction of your profits and continue operations. What's your move? You'd accept immediately. Then you'd resume exploiting the loophole. Because that's not accountability, that's a subscription fee. A toll booth on the highway of fraud. This isn't hypothetical. It's documented history in American finance. The institution is J.P. Morgan. The arena is precious metals trading. And the exploit is called spoofing. In this comprehensive investigation, we're examining one of the most significant financial crimes on record. We're analyzing the Department of Justice documentation from September 29th, 2020, when J.P. Morgan acknowledged systematic market manipulation in gold and silver markets and paid $920 million in penalties. We'll dissect their exact methodology. We'll expose how high-frequency algorithms created artificial supply signals to suppress prices on command. And we'll reveal the deferred prosecution agreement, the legal framework that kept executives free and the manipulation apparatus operational. They label it criminal activity. We're calling it the system exploit. This is how markets were engineered for profit extraction. This isn't speculation from internet forums. This comes directly from United States federal prosecutors. On September 29th, 2020, the DOJ issued a statement. J.P. Morgan Chase agrees to pay $920 million in connection with schemes to defraud precious metals markets. Notice their language. Defraud. Fraud. The bank confessed to tens of thousands of unlawful trades in gold, silver, platinum, and palladium futures spanning 8 years. 8 years of phantom orders. 8 years of price engineering targeting competitors and retail participants. According to the FBI assistant director overseeing the case, J.P. Morgan Chase and its employees conspired to unlawfully manipulate markets and defraud legitimate traders. The evidence is unambiguous. America's largest bank, custodian of the world's biggest silver reserves, was caught systematically rigging prices of the exact assets under their stewardship. But here's the critical question. If they were exposed in 2020, why are they still operating? Why does J.P. Morgan remain custodian for the largest silver ETF? Why do they maintain their commodity exchange membership? Because of the arrangement. $920 million, that figure dominates headlines. It projects severity. The public sees punishment. Nearly $1 billion seems like justice. But in institutional trading, context determines meaning. Consider the return calculation. The DOJ investigation covered 8 years of manipulation. During that period, J.P. Morgan's precious metals division generated billions in revenue. Industry analysts estimate gross profits from front-running and spoofing potentially reach tens of billions. Run a simple scenario. If an institution generates $100 billion over a decade through market rigging and pays $1 billion when caught, what's their net gain? $99 billion. The penalty represents a 1% operational cost. If you could steal $1 million and authorities said, return $10,000 and walk free, you'd build a career around it. This is asymmetric enforcement. The penalty doesn't deter the behavior, it incentivizes it. Shareholders absorb the fine. It appeared as a balance sheet entry. Did the CEO face incarceration? No. Did division heads? A handful of mid-tier traders were charged, but the institution persisted. The machinery stayed intact. That machinery operates today. How do you manipulate silver prices without executing actual trades? Through phantom liquidity. Visualize the order book as a vertical structure. One side shows buyers, the opposite shows sellers. Suppose silver trades at $25. J.P. Morgan wants to acquire silver cheaply. They want it at $24, but the market is climbing. Buying pressure is strong. The J.P. Morgan algorithm intervenes. It posts a massive sell order at $25.10, say 5,000 contracts representing 25 million ounces. Instantly, the market observes a barrier. Other traders see their screens and think, enormous seller at $25.10, massive supply incoming, price will collapse. Panic spreads. They cancel buy orders. They start selling. They attempt to exit ahead of the large seller. This selling pressure drives prices down. $24.90, $24.80, $24.50. The algorithm monitors the decline. When price hits $24, it cancels the massive sell order at the top. Those 5,000 contracts were never meant for execution. They were a mirage, a deception. The order existed solely to intimidate the market. Once canceled, the barrier vanishes. But damage is done, price has crashed. Now J.P. Morgan enters genuine buy orders at 24. They purchase the dip they artificially created with a fake order. That's spoofing. Explicitly illegal, banned under Dodd-Frank. but extraordinarily difficult to detect in real time because it occurs in milliseconds. By the time regulators investigate, the order has disappeared, money has changed hands, and the retail investor, who got stopped out at the bottom, never knew they were competing against a phantom. Spoofing's power derives from unequal information access. The bank knows which orders are legitimate and which are decoys. You don't. When you examine level 2 data on your trading platform, you see market depth, bars representing buyers and sellers. You assume that data reflects genuine intent. You assume those participants actually want to transact. But the DOJ report confirmed thousands of those orders were fabrications. This means price discovery in precious metals markets is compromised. Price should represent the intersection of supply and demand. But when supply is artificial, generated by algorithms that cancel before execution, then price itself is artificial. It's manufactured reality designed to extract wealth from honest participants. The bank operates as the house in a rigged casino. They see the cards, they control the odds, and when they're losing, they just create a massive fake sell wall to flip the table. This explains the flash crashes in silver. You wake up to silver down $2 in minutes with no news catalyst. Why? Because a spoof hit the market. It triggered stop losses. It cleared the book. Then price recovered just as rapidly. That wasn't market movement. That was harvesting. We know the crime occurred. We know penalties were paid. But why was the institution allowed to continue? Why wasn't their license revoked? Why didn't they get shut down? We're examining the deferred prosecution agreement. We're reading the fine print of JP Morgan's government deal. We're exploring the theory that authorities need banks to manipulate prices, that JP Morgan isn't a criminal, they're a state instrument. We'll examine the connection between the US dollar and precious metals. If gold and silver rise too high, the dollar appears weak. Could the system exploit actually be a monetary policy tool? For 8 years, the precious metals desk at America's largest bank ran a criminal operation. They deployed algorithms to place thousands of fake orders. They deceived the market. They crashed prices. They fleeced retail investors. And they admitted it. In a functioning system, fraud admissions lead to prison. If you or I rigged markets from our computers, federal agents would raid our homes at dawn. But JP Morgan isn't an individual. It's a systemically important financial institution. And in America, these institutions operate under different rules. We're exposing the legal mechanism that allowed JP Morgan to walk away. It's called the deferred prosecution agreement. We're examining the deal they struck with the Department of Justice. We're exploring the disturbing reality that government doesn't view the bank as a criminal, but as an ally. And we're answering, why does the United States government want silver prices suppressed? The bank paid the penalty but kept their license. This is how the enforcer became the accomplice. On September 29, 2020, JP Morgan entered a DPA, a deferred prosecution agreement. This legal instrument essentially places the bank on probation. The terms, JP Morgan pays $920 million. They acknowledge the misconduct. They agree to cooperate with future investigations. In exchange, the Department of Justice agrees not to criminally prosecute the bank. Consider the implications. The government possessed evidence, chat logs, trade data. They could have indicted the bank. They could have revoked its commodity trading charter. They could have dismantled the precious metals desk entirely. They didn't. Why? Because JP Morgan is too big to prosecute. Indicting the parent company risks destabilizing the global financial system. Bank runs, credit freezes, contagion. So the Department of Justice engineered a middle path, extract cash payment, let business continue. Critics call this cost of doing business, but it's worse. It's revenue sharing. When government fines banks for illegal profits, government essentially takes a cut. The bank steals from citizens. Government takes a percentage from the bank. Citizens get nothing. Yes, a victim compensation fund was established, but it represented a fraction of total fines. The vast majority went to Treasury and CFTC coffers. This creates perverse incentives. The regulator relies on fines for budget funding. If they shut down the bank, fines stop. So they keep the bank alive, keep the game running, just tax it periodically. The DPA sent a message to every Wall Street institution. You can rig markets, just save enough to pay our fee when we catch you. But there's a deeper, darker explanation for lenient treatment. It's not just about money, it's about currency. The United States dollar is the world reserve currency. Its power derives from confidence. Confidence in stability. Confidence in value retention. What threatens the dollar? Gold and silver. Precious metals are the anti-dollar. They're the Federal Reserve's report card. When gold and silver prices skyrocket, it signals to the world that the dollar is failing. It signals inflation, loss of confidence. Therefore, rising gold prices represent a national security threat. Look back at the 1960s. The US government actively suppressed gold prices through the London Gold Pool. Historical fact. They sold gold to maintain $35 pricing. Why? To protect the dollar. Fast forward to today. The government no longer sells gold directly, too obvious. Instead, they rely on bullion banks to manage pricing. Banks like JP Morgan act as central bank proxies. They sell paper contracts to absorb demand. They use spoofing to cap rallies. They keep real money suppressed so fiat currency looks strong. If JP Morgan stops suppressing silver, if they let prices reach $100 or $200, it exposes currency weakness. It accelerates the flight from dollars into hard assets. It threatens U.S. government's ability to borrow cheaply. So when the Department of Justice examined JP Morgan's spoofing, did they see crime or did they see necessary service? Did they see a bank doing the empire's dirty work, keeping the fear gauge broken so the public wouldn't panic? This explains the light punishment. You don't imprison your own soldier for following orders. You just fine them for getting caught. There's another layer to JP Morgan's dominance. They're not just traders. They're custodians. JP Morgan holds physical silver for the world's largest silver ETF, SLV. Hundreds of millions of ounces in London and New York vaults. This creates massive conflict of interest. Imagine a casino where the chip counter also plays poker. JP Morgan knows exactly how much metal exists in the vault. They know who's buying and selling. Information supremacy. The DOJ report focused on futures market spoofing, but it didn't touch the physical side. It didn't ask whether JP Morgan leases ETF silver to short sellers. It didn't ask if they trade against their own clients' inventory. By allowing JP Morgan to remain custodian, government effectively endorsed this conflict. They said it is acceptable for the fox to guard the henhouse as long as the fox pays a fine every decade. This allows JP Morgan to maintain stranglehold on physical supply. They see the flows. They front-run shortages. They use their physical hoard to backstop paper shorts. This is the system exploit in purest form. You control the vault, you control the paper, you control the price. And if caught cheating, you write a check and continue. The DOJ report revealed something else. Desk culture. Chat logs from the indictment were shocking. Traders bragged about spoofing. They called themselves the mafia. They joked about crushing retail speculators. This wasn't a rogue individual. This was strategy. Taught to junior traders by senior managing directors. Institutionalized. This tells us manipulation isn't accidental. It's the business model. These banks don't profit by predicting prices. They profit by moving prices. They create volatility where none exists. They trigger stops to generate volume. They farm the market like a crop. Retail investors are the harvest. When you buy a silver contract, you think you're betting on metal prices, but you're actually stepping into a cage match with a giant who controls gravity. The DOJ report proved this. It proved fair markets are mythology. There's no fair market when one player can place 5,000 fake orders per second to push prices wherever they want. We've established history. We know in 2020, the Department of Justice caught JP Morgan red-handed. They proved systematic market spoofing. They proved it was deliberate strategy to extract profit from retail investors. Back then, manipulation was offensive, about bonuses, quarterly earnings, greed. But fast forward to today. The silver market landscape has fundamentally shifted. Vaults that were overflowing are now draining. Industrial demand that was steady is now exponential, and current manipulation is no longer about quick profits. We're exposing the survival pivot. We're explaining why the system exploit has become life support. The banks are no longer suppressing prices to buy cheap. They're suppressing prices because if they stop, they face bankruptcy. They're trapped in a short position grown too large to cover. And the physical metal they need to exit that position is gone. This is how the predator became prey. To grasp the bank's danger, understand the difference between covered shorts and naked shorts. If you're a bank with 100 million ounces of silver in your vault, you can safely sell 100 million ounces of paper contracts. If prices rise, you don't care. You own the metal, you're hedged. This is how markets should work. But what happens when greed takes over? When you sell 500 million ounces of paper contracts, but only hold 100 million ounces of metal? You're naked, short 400 million ounces. For years, this didn't matter. The bank knew nobody would demand delivery. Investors traded paper back and forth. The bank collected fees and managed prices. Free money. But then came the shortage. Solar panels, EVs. Suddenly people stopped trading paper and started demanding metal. They stood for delivery. They drove trucks to vaults and emptied them. Now the bank sits with 400 million ounces of paper liabilities and an empty vault. They're naked. And prices are rising. In financial theory, long positions have limited risk. Worst case, price goes to zero. You lose your investment. Short positions have infinite risk. No limit to how high prices can go. If silver reaches $100 or $500 or $1,000, the bank owes that money. Run the math on exposure. If a bank is short 400 million ounces and silver rises $10, that's $4 billion loss. If it rises $50, that's $20 billion loss. $20 billion wipes out most institutions' Tier 1 capital. It triggers regulatory seizure. It ends the bank. So the bank cannot allow price increases. They have a solvency ceiling. If silver crosses a certain threshold, call it the kill zone, the bank dies. This is why spoofing has become so aggressive. In 2020, they spoofed to move prices 50 cents for scalping profits. Today, they spoof to prevent prices from crossing the kill zone. They place massive sell walls not to profit, but to prevent algorithms from calculating their insolvency. They're fighting for survival. This transforms the exploit's nature. The exploit used to be an ATM, now it's a shield. Every morning, bank traders wake up and assess physical demand. They see China buying, India buying, price pushing against their throat. So they activate the algorithm. They flood the order book with fake supply. They paint the tape red. They try convincing the world there's no shortage. They hope that if they keep prices down long enough, maybe demand will fade, maybe new mines will open, maybe recession will hit. They're buying time, but time is expensive. Every day they suppress prices, they lose more physical metal. Why? Gresham's Law? This is the ultimate irony of manipulation. By using the exploit to keep silver prices artificially low, banks accelerate their own destruction. Think about it. If silver trades at $70 on paper markets, but real fundamental value is $150, banks are putting silver on sale. They're subsidizing buyers. When Samsung sees silver at $70, they don't say the chart looks weak. They say thank you for the discount, and they buy more. When China sees silver at $70, they drain vaults faster. The lower banks push prices, the faster physical inventory leaves the West. They're draining the very collateral they need to survive. If they let prices rise to $200, demand would slow, vaults would stabilize, the bank might survive. But because they're naked short, they cannot let it rise. So they're forced to keep it cheap, which forces vaults to empty, which guarantees default. It's a doom loop. They're pressing the accelerator toward the cliff because the brakes are broken. You might ask, where are regulators? Where's the CFTC? We know from earlier that government views banks as partners in managing the dollar. But there's another reason regulators stay silent. Systemic risk. Regulators know banks are trapped. They see the short positions. They know if they forced JP Morgan to cover shorts honestly, prices would go vertical and the bank would fail. A failure of that magnitude would crash stock markets, freeze credit systems. 2008, all over again. So regulators look away. They allow spoofing to continue because the alternative, free market price discovery, is too terrifying to contemplate. They're complicit in suppression because they fear truth. The system exploit has become a financial stability tool, or at least the illusion of stability, so banks are trapped. Regulators are complicit. Physical metal is gone. How does this end? Does the bank win forever? Does the exploit work indefinitely? No, because you cannot print silver. We're examining endgame. We're explaining what happens when physical float hits absolute zero. We're looking at the force majeure event, where paper markets detach from reality. And we're delivering the final verdict on the greatest wealth transfer in history. The exploit is failing. The code is breaking. The reset is coming. For 4 decades, the exploit worked because nobody wanted the silver. Hedge funds traded paper contracts for cash profits. They didn't want 1,000-ounce bars delivered to Manhattan offices. So banks could sell the same ounce of silver 100 times to 100 different people. Musical chairs with 100 players in one chair. As long as music played, everyone was happy. But now, music is stopping. Industrial buyers don't want cash profits. They want metal. When Samsung buys a contract, they stand for delivery. When sovereign wealth funds buy contracts, they stand for delivery. This breaks the fractional reserve model. If 10 people demand the chair simultaneously, the bank must find 9 more chairs. But there are no more chairs. This is the delivery squeeze. It forces banks into open markets to buy physical metal at any price to fulfill contracts. This turns the suppressor into the superbuyer. The algorithm that sold paper to cap prices must now buy physical to avoid default. The machine reverses. And when a manipulation machine reverses, it creates vertical price spikes. So what happens when banks realize they cannot acquire the metal? When prices hit $500 and they're insolvent? Do they accept bankruptcy? No, they cheat one last time. They invoke force majeure. This clause exists in almost every futures contract and ETF prospectus. It states that if unforeseeable circumstances prevent asset delivery, the contract can be cash settled. The bank says, we cannot deliver the silver. The market is broken. Here's a check for the last closing price. You get fiat currency back, but not the silver. And because real silver prices on the street are skyrocketing, that cash is worthless relative to the asset you thought you owned. This is the ultimate rug pull. It converts hard asset owners back into fiat holders against their will. The system exploit ends by defaulting on the player. This is why, if you don't hold it, you don't own it. A paper contract is just a bet on bank solvency, and the bank is betting against reality. When paper markets declare force majeure, the pricing mechanism shifts to parallel markets. Screen spot, prices freeze or become irrelevant. Real price is discovered on the street. between refiners and battery makers, between local coin shops and stackers. In Shanghai and Dubai, we move from centralized pricing to decentralized pricing. In this scenario, premiums become prices. If spot freezes at $80, but you must pay $150 for a bar, the price is $150. Banks lose power to influence this market because they have no metal to sell into it. Their algorithms have no power here. This is silver's liberation. So where does this leave you? You're the one who saw the exploit, saw the DOJ report, saw the manipulation. But instead of rage quitting, you used it. You used artificially low prices to accumulate real wealth. You bought when they smashed prices. You took delivery when they wanted you trading paper. You removed your wealth from their casino. This is ultimate victory. The system exploit was a wealth transfer mechanism from public to banks. But by stacking physical silver, you reverse the flow. You use their suppression to buy strategic assets at a discount. You turn their greed into your opportunity. Now, as suppression fails, you're sitting on the only asset that cannot be printed, cannot be hacked, and cannot be defaulted on. You are your own central bank. Here's the verdict on JP Morgan and the DOJ. The system is rigged, always has been. Fines are just fees. Regulators are captured. Prices are managed. But rigging has limits. You can rig a casino, but you cannot rig a volcano. And the silver market is a volcano. The pressure of debt, inflation, and industrial scarcity is building beneath the surface. Banks are trying to cap the volcano with paper contracts. It worked for 40 years. But lava is starting to leak. We're entering the era where physical reality overwhelms financial fiction. The exploit is being fixed. The game is resetting. And the new game is played with ounces, not dollars.